Welcome back, my name is Arya, and I don't waste your time, so let's get straight into it. Constellation Software holds perhaps one of the most unique records that I've ever came across. For 19 years, this company did not have a drawdown from its all-time high of more than 25%. 19 years. Since its IPO in the year 2006, the stock never traded beyond a 25% drawdown from the all-time high. And during this period, the company had roughly a 30,000% return. So meaning had you bought the IPO, you would have been up 30,000%. But things have changed more recently, particularly over the last, call it 3 or 4 months since September. You might notice that that trend has finally been broken. It nearly held up for the 20-year anniversary, but over the past, again, 3 or 4 months, the stock has fallen by about 46%, and there's a variety of different reasons why this has happened. And so that's kind of the purpose of today's video. This has been a very, very durable compounder for essentially the entirety of its history. In my personal opinion, based off the research that I've done, it is in fact a very wide moat business, but some of those things are starting to come a little bit into question. Namely, the CEO actually stepped down recently due to some health reasons, and hence why the video that we're making today. Now, very quickly, a huge, massive shout out. I tweeted about it earlier. The Synopsis podcast by Speedwell Research. I would say probably 80% of my research came from their episodes on Constellation. They consistently kind of review the business and talk about it for years now. And there's just one episode in particular. Again, it's up on screen now. I'll be sure to link it in the description as well. Phenomenal breakdown of the business, the thesis, the culture of the company, everything like that. Again, I hope to kind of even emulate maybe half of what they've done over there with that podcast just in this video. But again, go to the original source. It's a phenomenal breakdown. And then additionally, a quick shout out to Fiscal AI, which is the sponsor of today's video and the software that you see in front of you. There's many reasons why I love Fiscal AI, but for example, I just showed you earlier that the drawdowns chart that they have over here, they recently added this new slider here where you're able to adjust the dates and be very specific in terms of how you kind of make these different charts. You're also able to bring in comparisons with, for example, the S&P 500 and whatnot, compare total returns, etc., etc. And obviously you're able to see that, CSU has been quite the compounder, right? Again, 2-week free trial, no card required, using the link in the description down below. And thank you to Fiscal AI. Now, with that being said, the business of CSU, many of you might be familiar with the company. Maybe a lot of you are actually invested in the company and whatnot. But just to kind of give like a high level explanation of what the business does, they're a serial acquirer. What that essentially is they just buy other companies. They particularly buy software companies. And if we wanted to be very granular with what type of software companies they buy, it's vertical market software companies. Now, don't worry, I'm going to explain all that in a second here, but essentially you can kind of think of them as a sort of Berkshire-esque company, and again, we'll come back to that later in the episode, why that comparison actually doesn't make sense in a lot of cases, but it's essentially a Berkshire for software. They buy a whole bunch of software companies, and they particularly are able to buy these different software companies at very attractive valuations. And in some cases, when they do buy them, due to their technical know-how of the business and understanding of the software market and these software companies broadly, they're able to bring in small software companies that are maybe not being ran efficiently, make a couple tweaks, increase the margins, increase revenue growth, maybe change the businesses from being a licensing model to a SaaS model, whatever the case is, and able to drive sort of high returns from those software companies. And usually they tend to try to want to hold on to these companies forever, basically, and take a very long-term view with the companies they do buy. Next question you might ask is, okay, well, how many software companies do they buy? And do we have, specific names and whatnot? They do have roughly 7 operating groups, which are kind of like broken down into, specific industries and whatnot. We can take a look at that in a second here. But as it stands currently, within those roughly 7 operating groups, between all of them, they own roughly 1,000 different software companies. And again, these are generally small software companies of, between 5 to maybe 10. In some cases, the bigger ones, maybe 20 or $30 million of revenue. This is not like they're buying your Adobes out there, or they're buying like a Canva or something like that. These are very, very small software companies, and that's by design. So vertical market software, there's a key distinction between vertical and horizontal. Horizontal market software would be something like, Microsoft Excel, or like it applies to all different industries. Vertical market software might be very, very specific for just one industry in particular. And so again, from the Speedwell Research podcast, one of the examples they used in there was chicken coop software, where it counts the number of eggs that a chicken inside a chicken coop is laying. And so again, like you might imagine, the only sort of use case for something like that, and the total addressable market of something like that, is quite literally just farmers, right? So it's a very, very narrow customer segment that you could be selling to. There's like bus scheduling software that they also sell, or excuse me, that they are also own, right? So again, like a local bus scheduling software for just like a certain metropolitan area with rules and regulations in that area, right? Like again, that is a very sort of niche software that they would want to own. Additionally, there's like funeral home management, right? Or like cemetery management, dental clinic software. So the idea generally is that they're buying these different software companies that are very, very mission critical to the businesses that are using them. So again, you can imagine like bus scheduling software. You quite literally need it every single day to be able to do the routing of these different buses and whatnot. And, switching costs are probably very immense, as is with software broadly speaking. And so they've often kind of described them as like micro monopolies of like, it's very niche, it's very specialized workflows. Again, like chicken coop software, right? Like that's super, super niche and super, super particular just for that use case. And usually there isn't that much competition with stuff like this, right? And they become super sticky, super mission critical. They have generally low levels of competition within each of these sort of verticals. And you would also imagine like there's not going to be that many people that are looking towards possibly creating the next great chicken coop software, right? And so that's sort of the gist of it, right? And particularly on a sort of operating level with CSU in particular, the reason why they've been so good compared to competitors such as maybe private equity or other companies that have tried to kind of be Constellation software copycats over time is surely due to scale. So the reason why Constellation has done it so much better than other competitors is it's a relatively easy, and again this goes back to something that Synopsis podcast they talked about, but it's like relatively easy for private equity to value a company with 20% margins that is a SaaS company doing, I don't know, $5 million of revenue, right? But it starts to become a little bit weird when it's like, they're not even EBITDA profitable. And then it's like a licensing model. And, you would have to like transition that company from a licensing business to a SaaS business and potentially like make some other tweaks to kind of really be able to make a comfortable return on that business, right? Like a company doing $5 million of revenue with maybe 2%, 3% EBITDA margins or something like that as a licensing business. And like, oh, what would the returns look like if they do switch to a SaaS model? Like the private equity companies that have only done 25 transactions over their history into vertical market softwares, they just don't have the track record or the history of being able to successfully transition a company with that backdrop and turn it from a 3% EBITDA margin licensing business to a 20% margin SaaS business, right? But Constellation Software has built that technical know-how and essentially serves as like a very high level sort of like kingmaker and can give like very high level consulting advice to be able to make these businesses super successful. And so that's kind of a explanation into what the business does. Again, some of you may have already kind of known the history with that. There is other factors when it comes to the moat, which I won't be diving into too much within this video. Let me know if you'd like a widest moat you've never heard of episode on this. I'll be happy to kind of dive a little bit deeper into that and do like a longer sort of like 30-40 minute deep dive particularly into the moat and go through some writing and whatnot. But for the scope of today's video, that's kind of the stuff that you need to know. It's a vertical market software business. They are uniquely differentiated in the sense that they have a massive amount of scale and a massive amount of history and track record with doing these different transactions. But shifting gears a little bit here, why is the stock actually down? And there's a couple different reasons for this. But first and foremost, and again, Fiscal AI 2-week free trial, no card required, using the link in the description down below. The first issue that they are starting to kind of see is that their revenue growth has been slowing down over the past little while. Now, it was never, expected that they would actually sustain revenue growth of 30% or thereabouts. In all my time that I've analyzed this business, I've always expected that they would kind of revert back to the mean of roughly in that 15% range. It is, I believe, 5% organic and like 10% through acquisitions, right? Because again, that's kind of the gist of the business is they continuously acquire these different companies. But at the same time, that is kind of serving as a backdrop as to some of the fears that investors have had with Constellation for a handful of years now. One of the fears has been they have gotten so big that they're going to start running out of ideas and acquisitions to continuously do, right? So they've gone to a point where there is now, I believe, like 1,000 or so companies that they own. Now, granted, there is roughly 50 to 60,000 estimated vertical market software companies out there, but of course, not all of them are on the market to be sold. At the same time, like even if they are being sold, it's probably not at valuations that Constellation would be looking at possibly owning these companies, right? So we are kind of hitting the law of large numbers within Constellation. Now, they've floated the idea that maybe potentially, I believe that in the year 2020, they considered buying like an oil and gas company or something like that. So they have floated the idea of like diving into alternative assets, not necessarily vertical market software, but other very undervalued assets that could potentially keep the returns going in the future. I would suspect at some point in the future, if they do hit the wall in terms of possible acquisitions, that's something that they would consider. And then point number two, why the stock has sold off, and this was like essentially immediate. I think the stock sold off 7% or so on the day of this news, is the president and CEO and founder, Mark Leonard. He did step down in September due to health reasons, which, hopefully everything's okay with him. We didn't get much details into what exactly is going on with him, but hopefully he's fine. And then the COO, Mark Miller, was appointed as his successor. Now, A lot of people have wrongfully, I would say, and this goes back to the Buffett and Berkshire comparison, wrongfully have assumed, oh, this is, similar to like a Berkshire situation where like, oh, you have this great capital allocator at the helm, and now that they're losing it, they're kind of losing talent and losing the magic at the company. Now, I would completely disagree with that in the sense that if you look at the way the company is structured, it's actually quite different than how a Berkshire is structured. So Berkshire buys these different companies, right? For example, a Geico or all these different oil and gas pipelines and whatever the case is. And their strategy has always been whatever money you make, send it back to Omaha, and then we're going to allocate into different opportunities to create shareholder returns. Whatever excess profits you make, give it back to us, and then we will kind of divvy it up where that money needs to go, investment areas, etc., etc. The way that Constellation has ran things is they've kind of tried keeping things very, very decentralized. So this is off of their own website, and as you can see, they have these different operating groups that I mentioned earlier, and I do suggest I'll link this in the description as well, but like it kind of breaks down into what specific industries these different operating groups generally try to lie in. And so the idea with this has always kind of been that Constellation is going to remain decentralized, meaning these operating groups, whatever money you make from these different acquisitions and whatnot, just keep the money yourselves, right? Like we don't want to be making, in some offices in Canada, we're not going to be making all these different capital allocation decisions. And frankly, we can't because there's way too many deals and way too many companies. So up until a certain sort of size in terms of acquisitions, you guys kind of make the decentralized decisions. And so they've built up this machine over time that is able to act on its own and make these different acquisitions at the rates of return that are attractive to the company. And of course, at some point, if you're making acquisitions that are 25, 30, $40 million, right? Like they are going to bring the parent company in. And so Constellation themselves will get a little bit more involved and hands-on with those sort of bigger deals. But in general, up until a certain point, these operating groups are able to be decentralized and be able to make those capital allocation decisions. And this is how it's always been ran, right? Like the company, I don't know what the year exactly is, but at some point, I don't know, maybe a decade ago or thereabouts, they hit a certain size where they're like, okay, we cannot be running these acquisitions, every single acquisition through the main office. There's just too much at the best bit. And so when the CEO does step down, of course, we would much rather prefer that the CEO did not step down, but it ultimately doesn't matter that much to the long term of Constellation Software because this is a very, very decentralized company. And it's always been ran as a decentralized company where the capital allocation decisions can be made by all these different managers and leaders within the different operating groups. And then point number 3, which we have done, 3 or 4 videos over the past week or two, it's just software as a whole is kind of selling off due to fears of being disrupted by AI. And if you've been a viewer of the channel for the past little while, you know that I am very much on the opposite side of that argument. I think in many, many cases, I think actually it'll be similar to sort of the internet era and the dot-com era where we saw, these software companies, for example, like an Oracle did adapt, but like, of course, it's not as dominant as it used to be with their softwares and whatnot, right? So that's kind of what I'm thinking is probably going to play out over the next little while. You have your narrow moat softwares that end up being disrupted. Some of them go out of business, whatever the case is. But overall, the companies with massive distribution and the companies that have, been industry leaders, for the most part, like in a very, very bad case scenario, these companies probably lose a little bit of market share, don't adapt as much. They're not as dominant in the new paradigm. But for the most part, they should be able to integrate AI features into their softwares and survive this transition into moving from SaaS to the AI age of software. That's my general opinion on it, particularly in the case of a Constellation Software. I think that just doesn't even matter in general because the companies that they are buying are in some cases 30, 40-year-old licensing softwares, very, very clunky. Again, like chicken coop software. You can't imagine that has like a fancy UI, right? And the reason that they're buying it is because it's very mission critical to the person that is the customer of that software. And the customer of that software, the farmer or whoever that needs the chicken coop software, the reason they're not switching is because it's so mission critical. It gets the job done. It's a low percentage of their costs, and they just don't want to risk potentially moving on to a different software, having to potentially retrain employees. All their data is stored inside of that. For example, in this case, how many chickens have laid what eggs and etc. Right? But again, like bus scheduling routes, right? Like that's a lot of data that has been stored in there. So there is very much material switching costs, and in some cases, you're selling to sort of small to medium-sized businesses, and it's just a lot of headache to want to switch something like that. The example I always kind of give is like you started using an Apple iPhone 10 years ago and like you haven't switched to this day, right? Or most people haven't switched off of that iPhone. And in fact, they have continuously bought more and more Apple products, right? So that is kind of how we describe most softwares, not all softwares. but most softwares, B2B softwares that is, you start using it and the more you use it, the more difficult it becomes to switch off eventually. And so it just becomes too much of a headache, right? Like you've stored all your photos on iCloud and all your contacts in the Contacts app, and then you have your Apple Watch, which is integrated with your iPhone, and then your AirPods connect with your MacBook, right? Like you have all these different nice integrations and all these different pieces of information that you have stored onto your iPhone, and all your different apps are logged in, right? Like there is very serious material switching costs to moving off of the iPhone ecosystem. And it is frankly, for most B2B softwares, it is very similar dynamic. It's not an Adobe or Salesforce video, but I would say, for example, like Adobe or Salesforce are very much clear examples of exactly that. And so with Constellation software, for the most part, and this is kind of a bit of an issue that I have with the company, is we don't actually get too much clarity into the exact sort of companies that they own. But for the most part, a chicken coop software, bus scheduling, a cemetery management software of like, who's where, whatever the case is, right? Stuff like that. Like that is very much, you guys get the idea, very much mission critical, very much high switching costs. Now, finally, moving on to valuation, one thing to be very, very careful with this, I saw a lot of these sort of charts floating around over on Twitter. Yes, the price to free cash flow is very, very cheap. Mind you, this is not actual free cash flows. And the way we can show that is they have this KPI called free cash flow available to shareholders, right? So because it is a sort of serial acquirer, the actual free cash flows that the company generates versus the free cash flow available to shareholders, these are two different values. And so overall, for you, if you don't want to be constantly doing the math and whatnot, roughly they convert 70% of free cash flows into free cash flow available to shareholders. I can show you a custom metric on that as well. So here we are. So yeah, again, roughly 70%. It has kind of declined ish over the past little while. By the way, something very cool you could do with Fiscal AI, you can make custom metrics like this, right? So I've simply taken free cash flow available to shareholders and divided it by free cash flow, and that's how you end up with this custom metric here. But basically, if you take the US market cap divided by the free cash flow available to shareholders, you end at roughly 25 times free cash flow, and that is actual free cash flows, because something you might notice is if we search for share-based compensation over here, or if we simply go onto the cash flow statement and try to look for it, you might notice there's no such thing as stock-based compensation or share-based expense. It simply does not exist on their cash flow statement. And the reason for that is because this company in its entire history has never, and that's such a green flag, but has never issued stock-based compensation. And another funny thing that I can kind of show you while we're going about this is the total shares outstanding of the company since IPO has remained completely flat. It has been 21,190,000 shares since IPO. They have never diluted, and the acquisitions they're doing is not through equity. It's always through cash, hence that free cash flow available to shareholders number, by the way. And yeah, it's a phenomenal company culturally. And actually, their employees, their high-level employees, need to actually use some of their after-tax income to invest into the stock to be aligned with shareholders. And so, again, they don't issue any stock, but they force their employees to use their after-tax income to kind of invest back into the company, right? And so, anyways, with that being said, it's completely clean. This is a clean stock-based comp adjusted, well, you don't even need to adjust it, but stock-based comp adjusted price to free cash flow of roughly 25 times for a company growing revenues at sustainably probably around 15%. Free cash flow a little bit faster than that, so it'll be, I don't know, roughly 17% or so. It's cheap. You know what? It's definitely a great opportunity. I have some of my issues with the company is kind of that black box element to it, where like at the end of the day, you don't really know exactly what sort of software companies you're buying. You do have to kind of trust the track record of the company, and they've compounded capital at such a high rate for so long that you kind of just trust the management team at some point and trust the decentralization of it, the machine that has been built under the hood. But again, in my personal opinion, I have sort of better ideas that I maybe understand a little bit better with, like, for example, Adobe and stuff like that. Because with Adobe, I'm looking at also similarly 17% free cash flow per share growth, but at 16 times cash flow. So it's cheaper in my personal opinion, and it's a little bit more in my circle of competence. But other than that, let me know what you think. You guys have been asking for this video for a long time, so feel free to drop stuff in the comments. I'm sure I missed a whole bunch of stuff. This company is qualitatively a phenomenal business, so be sure to leave me comments down below. And other than that, thank you for watching and have a great day.